Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about FTAI Infrastructure Inc. quarterly report. FTAI Infrastructure Inc. offers a diverse range of businesses and services across various industries. The company's key areas of operation include railroad operations terminal management, Jefferson Terminal and Rapano, power and gas infrastructure development sustainability, and energy transition initiatives, including plus waste plastic to renewable fuel production plus lithium-ion battery, recycling plus hydrogen-fueled power generation, plus carbon capture businesses. Additionally, the company operates 2 deepwater ports along major rivers in North America, providing industrial development opportunities. The stock price of FTAI Infrastructure Inc. has significantly dropped in the past year due to a combination of disappointing financial results and broader market concerns. Key events contributing to this decline include disappointing earnings reports, such as the second quarter 2025 financial results, which fell short of analyst expectations, and weak third quarter 2025 earnings that led to a substantial EPS miss. Widening losses over the past 5 years, with profitability not expected for at least 3 more years, challenging optimistic growth narratives. Leverage and financing pressure on margins due to $1.25 billion in new debt and preferred stock at a 10% dividend rate, increasing interest and dividend burdens. Broader market weakness and economic concerns, including declines in major indices and negative investor sentiment, driven by government shutdown fears and weaker-than-expected consumer confidence reports. These factors have collectively contributed to the company's stock price decline of -34.55% over the past year, with significant volatility evident in its 52-week high and low prices. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key contributors include increased refined product throughput volumes, expansion into new markets such as Mexico, and rising demand for storage on the U.S. Gulf Coast due to refinery expansions. Additionally, movements in future oil spreads and the execution of contracts related to sustainable fuels have also contributed to revenue growth. On the decline side, factors such as decreased crude by rail volume, increased railcar regulation compliance costs, and disruptions in railroad operations have negatively impacted revenue. Furthermore, environmental regulations, fluctuating fuel prices, and changes in government laws and regulations have also posed challenges to revenue growth. Overall, the company's ability to adapt to changing market conditions, regulatory requirements, and customer needs will be crucial in maintaining a stable revenue stream. Net income and profit margins. A shift in fortune. The financial performance of a company has undergone significant changes between 2024 and the 9 months ended September 30, 2025. Initially, net income plummeted to -$405,818 in 2024, but surprisingly increased by $455,023 to $50,205 in the same period of 2025. However, this trend was not consistent across all quarters, as the 3 months ending September 30, 2025 saw a decrease in net income to -$92,000 from $214,000 in 2024. Profit margins also experienced fluctuations. The adjusted EBITDA margin showed an increase from 21% to 29.1% for the 3 months ended September 30, 2025, and from 24.4% to 26.2% for the 9 months ending September 30, 2025. The reasons behind these changes are multifaceted. The increase in net income can be attributed to other comprehensive income and settlement of equity-based compensation. Additionally, a partial release of valuation allowance and reclassification of taxes due to the acquisition of Long Ridge Energy and Power LLC contributed to this shift. Other factors influencing the change include interest rate fluctuations, contractual defaults, asset value depreciation, regulatory compliance issues, environmental contamination, and fuel price volatility. These changes indicate that the company's financial performance is subject to various external and internal factors, which can have both positive and negative impacts on its net income and profit margins. The company's financial performance in 2025 is mixed. While it initially reported negative operating cash flow for the year, $115,255, a closer look at its mid-year performance reveals a more promising trend. As of September 30, 2025, the company had already generated a positive operating cash flow of $25,247. This suggests that the company may be on track to achieve a net positive operating cash flow for the year, indicating improved financial health and management. The company's financial situation has undergone significant changes. The total debt level has increased substantially from $1,918,032 to $4,372,947, representing a 129% increase. Furthermore, principal debt due within 1 year has skyrocketed by 29.3%. Interest expenses have also seen a substantial rise, with a notable 134% increase in 2025 compared to the previous year. These changes indicate a significant shift in the company's financial obligations and expenses. Management is expressing cautious optimism about the company's outlook and strategy. While the primary objective remains to acquire infrastructure assets, management acknowledges potential risks and challenges, including competition from other funds managed by Fortress. The company faces various financial, regulatory, and market risks that could impact its business and financial condition. Key concerns include fuel price volatility, deteriorating relationships with Class I railroads, and competition from other transportation providers. Management must also navigate the complexities of acquisitions in new sectors, regulatory compliance costs, and potential tax implications. To mitigate these risks, management is focused on effectively managing the expanded operations following the Wheeling acquisition and adapting to changes in market conditions. However, the company's ability to achieve its objectives remains uncertain due to various external factors beyond its control. Acquisitions and divestitures overview. Fortress Transportation and Infrastructure Investors LLC, FTAI, has made several strategic acquisitions to expand its portfolio. Notable acquisitions include the purchase of SoftBank Group Corp's equity in Fortress Investment Group LLC, Repauno Assets through Delaware River Partners LLC, the Wheeling Corporation, Jefferson Terminal, Transtar, and FYX. In addition to these significant purchases, FTAI has also acquired Wheeling Acquisition, although no specific date is mentioned. These acquisitions demonstrate the company's commitment to growth and diversification. On the other hand, FTAI has made some divestitures as part of its business strategy. One notable example is the transfer of KRS, a railcar cleaning operation, from the railroad segment to the corporate and other segment. This move suggests that FTAI may be reorganizing its operations or focusing on core businesses. The company has a history of paying dividends to its shareholders. According to the financial summary and supporting pages, cash dividends were paid out for common stock in both 2024 and 2025, totaling $10,342 and $9,707, respectively. Additionally, dividend payments were made in the 3 months ended September 30, 2025, amounting to $25,311. However, there is no mention of share buybacks throughout the report. Concerns about inventory buildup and supply chain disruption exist. The company faces concerns regarding inventory buildup and supply chain disruption. The financial summary highlights several issues that indicate potential problems in these areas. Firstly, the loss on inventory heel for the 9 months ended September 30, 2025, is a significant concern. This suggests that the company may be holding onto excess inventory, which can lead to wasted resources and decreased efficiency. Furthermore, lower volumes due to the termination of the butane throughput contract in March 2025 have also been reported. This indicates a potential disruption in supply chain operations, which could impact the company's ability to meet demand. Additionally, there is a risk of a severe shortage of domestic fuel supplies, which could have a material adverse effect on operations and liquidity. This highlights the vulnerability of the company's supply chain to external factors, such as changes in market conditions or disruptions in fuel production. Overall, these concerns suggest that the company needs to address its inventory buildup and supply chain disruption issues to ensure continued operational efficiency and financial stability. That concludes the financial summary for FTAI Infrastructure Inc. Feel free to comment below, and I will be happy to answer them when possible.